At the top of the show, we mentioned we had an experienced, talented lineup, and our next presenter is a professional day trader of the E-mini futures markets and swing trader of stocks. A Chicagoland now living in sunny Scottsdale, Arizona, he openly shares his methods throughout the trading community and is a regular speaker at Traders Expos. When he's not in front of the computer trading, you'll find him outside hiking, riding his mountain bike, and exploring new places. Here to present better entries and exits with NYSE Tick, it's my pleasure to introduce Mr. Tim Racette of E-mini Mind. Welcome to Traders Corner, Tim.
Hey, thanks, Rob. Great to be here.
Great to have you.
So we are just about back on schedule, so we can jump right in if you're ready and everyone else is ready. We're going to be talking about the NYSE Tick today, and specifically how it relates to day trading futures and how you can use both the NYSE Tick and the NASDAQ Tick to improve your entries if you are day trading. So we're going to go through a good amount of information here in the next 45 minutes or so. I'll do my best to keep an eye on the question window. So if you have questions, feel free to drop them in there, and I'll try my best to answer them as we go. I would say the NYSE Tick is a little bit more of a intermediate to advanced concept for newer traders. So if you get lost a little bit along the way, don't worry, it does take a little bit of time, or can take some time to get used to, but the more you spend time in front of the screen and the more time that you spend looking at the charts and studying the markets, especially if you can focus in on just one market and one time frame to really master the mechanics, then the easier it will be to scale down the road. So as Rob said, my name's Tim. I blog over at eminimind.com, and as the name sort of implies, my main focus is day trading the futures markets, the E-minis to be exact. So I been trading since about 2006. Grew up in the Chicagoland area, so I had a ton of opportunities to get down town and spend time at the Board of Trade, spend a little bit of time down there on the floor, got to meet and get in touch with, kind of build relationships with some really, really great traders who, the guys down on the floor, was mostly guys, a handful of gals, they really encouraged myself and a friend of mine that you don't want to be spending too much time learning the ways of the floor traders at this point, because the pits had been getting smaller as the years went by, and most of the traders in the pits were already using terminals, computer screens, charting their trades, and then just going into the pits to place those orders. So having that advantage of being in the Chicagoland area, I got to, before in the early days of Thinkorswim, which was then acquired by TD Ameritrade and then acquired by Charles Schwab. Tom Sosnoff, the co-founder, you walk into Thinkorswim and got a chance to get to know Tom and spend time at the Traders Expos and things like that years ago. So when you're in a place like a Chicago or in New York, where you have access to a lot of great talent and information, definitely take advantage of it. So like I said, mostly my trading is focused in the E-mini futures markets. I also do swing trade individual stocks, and it does make for a nice pairing. So if you currently swing trade and you're looking to get a little bit more active on the day trading front, it does really complement the swing trading or holding overnight, because when volatility is really high, you tend to have a lot more opportunities in the intraday getting in and out side of things, because the markets are moving a lot quicker on an intraday basis. The ranges for the day are a lot bigger. But when volatility is really low, if you think back to prior to COVID, the market's in a strong, very tight, narrow uptrend, and you could get in individual stocks, and whether you're doing some simple option strategies or just buying the stock outright, and you can stay in those stocks for quite a while because there's not a lot of volatility. So they do make for a nice pairing. We're going to focus mostly today about day trading, and the NYSE tick and the NASDAQ tick. Both are probably the most useful tool you can use to trade the E-mini futures. When I'm looking at the NYSE tick, I'm mostly trading the E-mini S&P, and then when I'm looking at the NASDAQ tick, I'm obviously trading the E-mini NASDAQ. So we'll get into those details here shortly. Spend some time, like I said, down at the Board of Trade, doing presentations at the various expos, the traders expos, and the last couple of years things have been a little bit quiet, so I've been doing more of these virtual presentations, but always nice to get together with folks and kind of come together, because as you know, trading, again, sitting here in front of your computer screen can get a little bit boring at times. So I like to spend a lot of time outside, outdoors. I now live in Scottsdale, Arizona. I kind of split my time between here and formerly Colorado, but then now we're going to be going up to the Black Hills, South Dakota in the summers instead of Colorado. So spend a lot of time outside as much as I can. I'm sure you've experienced this too. You know, those breakthrough moments or those light bulb moments that you've had when you're trading don't necessarily come when you're sitting in front of the screen in a trade. They come when you're, going through your notes afterwards, when the markets are closed, or you're outside on a walk, or when you're reading a book that has absolutely nothing to do with trading. Your mind is still working. And so when I get outside and, get away from the screen and I'm not actively thinking about the markets, that's when a lot of pieces have fallen together in my own experience from my trading over the years. So just a couple of shots of some of the things I like to do. The more you can keep a balanced life, and the more you can keep other hobbies involved in your life, the more sustainable trading will be. Because if you go all in, and when I first started, I was younger and I was in college, and then coming out of college, basically traded most of the day, and then I would even wake up and trade the European session as well. And when you're all in, you can learn a lot in a really short period of time. But in the long run, that's not necessarily the most sustainable approach. So trying to, most folks don't have the benefits of being young, having essentially no responsibility, very little obligations in terms of expenses. And so if you're already into the, more responsible adulthood part of your life, there's going to be a lot of things pulling at you. And so try not to go all in the sense of trading with a kind of be all end all or an ultimatum, like, oh, I have to, become a successful trader by December 31st, because if I don't, I hate my job, I want to quit my job, and that's all I want to do. Instead of putting the focus on those types of ultimatums, switch your focus to, okay, we want to be focusing on how can I improve my trading, because the scaling up portion is relatively easy. So if you can, focus on mastering your strategy and how you're looking at the markets, your entries, your exits, and your trade management, then, once you can work your way up, if you're going to, dabble with the micros for a little while and then work your way to the regular minis, then you can go from 2 to 4 to 6 to 8 contracts, essentially overnight. But you're not going to have the confidence to be trading 6 or 8 contracts if you don't have, 100, 200 trades under your belt with just 2 contracts. So you can go back to those stats and feel confident in your trading strategy. So those are just kind of some of the, I guess, bigger picture viewpoints that I have towards trading that, for the last, 15 or so years now, have really helped me, do this and continue to do this year after year after year without getting burnt out. I should also say my background is also competitive mountain biking. So a lot of my experience that I bring to trading comes from, the training side of bike racing. And so if you try to, just like any sport, do that sport year round with no breaks and go, hard all the time, you end up getting burnt out. Whereas if you can plan some breaks, then it becomes a lot easier to sustain that over the long run. So throughout the year, we've got expiration happening 4 times a year. We've got some holidays that occur that kind of break up the trading week. So if you can kind of structure your year in a way that allows for some, planned breaks, use that time to, go on family vacation, do, other fun things that you like to do and get away from trading and not feeling guilty about it. That's another thing that's really, I think, added to a lot of sustainability for me over the long term, because yeah, it's easy to get burnt out in whatever you're doing. So the reason I currently live out in Scottsdale, got turned down to Arizona from going to ASU. So former Sun Devil, and lived in Madison for a while, and then worked my way back here in Scottsdale. And there's really no place I'd rather be after living in Wisconsin and Illinois for so many years and having to deal with winter. So let's dive into the NYSE tick, shall we? The first thing I want to start with is what the basic tick chart looks like, and then we'll get into some of the specifics here. But just so you have a picture in your mind of what is this thing called the NYSE tick. And essentially, the chart itself can be set up in a variety of different ways, but the NYSE tick is derived from the New York Stock Exchange index, and it's giving us the relationships of stocks that are ticking up, moving up versus moving down. So if I go back to that chart for a second here, the movement that you see on the NYSE tick chart is the net number of stocks that are moving up, down, or unchanged. So if the chart was reading 0, it doesn't mean that no stocks were moving. It means that in the New York Stock Exchange, you may have had, there's roughly 2,500, give or so, stocks. You could have 1,000 stocks moving up, 1,000 moving down, and then 500 that were unchanged in the last print. And that gives you a net number of 0. So that is the kind of visual representation that the chart is giving us. So the NYSE tick is obviously derived from the NYSE, New York Stock Exchange. The NASDAQ tick is derived from the NASDAQ price data. So all of the the 2 separate charts, NYSE tick, NASDAQ tick, you want to use the NYSE for the ES and the NASDAQ for the NQ. And that net number is really, really valuable, because that NYSE tick reading is going to give you a number, anywhere from maybe plus 1,200 to minus 1,200 and anywhere in between. And the more extreme that you get, the less variables that can be in play to give you an extreme reading. So a 0 reading, like we just said, could be 1,000 stocks going up, 1,000 going down, and 500 unchanged. It could be a whole host of numbers, those 3 variables, up, down, and unchanged, to give you 0. But as you get towards the extremes, plus 1,000, you got to have at least 1,000 stocks going up, and then 1,500 could be unchanged. But more than likely, you've got 2,000 going up, and then maybe 500 unchanged. And so that's really where the value lies in the NYSE tick, is looking at extremes. And I guess from here on out, when I say NYSE tick, you can just use the same concepts and price information, just substituting NASDAQ tick. So those readings, a plus 1,500 would be about as extreme as you're going to see on a NYSE tick. Plus 1,000 is really, plus or minus 1,000 are those big important numbers, and it's just based on the very last price. So you could call an indicator, you call it a tool, but it's just based on the last price of all the stocks that are trading in the NYSE, and what is that reading? What is the net number result? And so with that information, we can look for opportunities intraday that correspond with the ES moving up or down. You could also use the YM. There's a few other, I guess, versions of the tick, NYSE, NASDAQ, but those are the kind of the main two. And out of all the things that you could be looking at for trading, you could use any strategy that you want as far as the entry criteria that you're looking for. But no matter what you're using for your entry, it's always helpful to take a glance at the NYSE tick and determine if this is indeed a good entry point. And we'll get to those some of those specifics here in a few minutes. So I like to add a 1 period moving average to the chart just to help kind of visually give me some trend information. You could use a bar chart, you could use a candlestick chart, it really doesn't matter. But I just have my NYSE tick data set for a 1 minute bar chart with a 1 period moving average. I'm the NASDAQ. I'm okay with not having that 1 period moving average, as we'll get into here in a few minutes. When I look for trades on the NASDAQ moves so dang fast compared to the ES that I almost like to minimize it down to the bare minimum. And so I find that not having that 1 period moving average is helpful. But in general, just like you would look at a chart for trend lines, support and resistance, those kinds of things, you can do the same thing with the NYSE tick. Just glancing at this snapshot, you kind of have a general series of lower highs and lower lows, and all of a sudden, boom, you get a spike in the NYSE tick. And so those relative, lower high, lower low situations can correspond with downtrends, and obviously higher highs and higher lows can correspond with uptrends. That zero line is really helpful to pay attention to, because if we're just trading in a very tight range, plus 400, minus 400, plus 200, those numbers aren't as extreme. And so we're not really going to have that much actionable information when we're trading near the zero line. It's kind of like if the amount of volume that's going into up stocks versus down stocks is roughly the same, and it's this tug of war game where both sides are about equal strength, well, neither side of the rope is going to move very far left or right. But if the bulls are much stronger and there's a lot more of them, there's a lot more volume going into stocks moving up, well, then that tug of war game, the bulls are going to pull their side much further and have a lot more movement. And so that balance, just like you would look at volume, can be looked at on the NYSE tick with the actual number of stocks that are going up versus going down. So the way I like to use the NYSE tick here is looking for those extremes, and then essentially what it's giving you, what the NYSE tick is telling you, is that all of these stocks have moved in one direction all at once, and that's just not sustainable for a long period of time. So when you get those extreme tick readings of plus 1,000, you tend to have a snapback or a retreat, if you will, after that reading has printed. And if you get an extreme tick reading to the downside, minus 1,000, you tend to have a snapback of price to the upside. So just with those two pieces of information, you can kind of deduce that, okay, I want to be looking to sell high ticks and buy in low ticks. So a lot of the times the market isn't trending, and this becomes very, very helpful when it's more of a range bound day, we're moving sideways. And so if you're stuck with just a trend trading strategy, or if you're kind of looking for some help to determine, well, do I want to buy this breakout or do I want to sell this high? The NYSE tick can be a really helpful way to determine that. And then another thing you can do, just kind of as a side note, print out or take snapshots of a whole bunch of trend days, and then look at all those trend days side by side, and kind of you'll start to notice similarities in the way that the market moves, especially if you're only zooming into one market. So if you're just looking at the E-mini S&P, for example, just look at a 5-minute chart or a 15-minute chart for the day, and then do the same thing with a whole bunch of range-bound days. Take a bunch of snapshots or print out a bunch of range-bound charts and look at those side by side. and you say, okay, well, there's some similar characteristics here on the range bound days, and you become really familiar with, okay, what does a range bound day look like? What does a trending day look like? And then when you put the two groups of them side by side, it's like, okay, well, yeah, this, obviously looking at it at the end of the day, it makes it very clear, oh, this is a range bound day. And then we look over here, oh, this trend day, yeah, that's obviously, it's super clear. We're making higher highs and higher lows. It's a strong uptrend. But you'll be able to start picking out little nuances that are occurring early in the day that lead to one of the two types of days, or at the very least, you might be in a range bound morning session and then you start trending in the afternoon, or vice versa. And you can start to pick out those little similarities that help you, make the correct decisions of, okay, I want to be buying in this trend, or do I want to be fading in this. What looks like a trend at the time might be a little uptrend, then a little downtrend, then a little uptrend, and lo and behold, we've been range bound for the last 2 hours. So the NYSE tick is really helpful for that in itself. I don't really use the NYSE tick to necessarily get me in or out of swing trades. I'm not, you have to be much more diligent and picky with your entries when you're on a smaller time frame. But when you get to a bigger time frame, it's not as critical. If I'm 50 cents or even $1 off on my entry, and it's a longer term swing trade, and you're talking it's a Tesla or a Google or something that's up near upwards of $800 or $1,000 or $2,000 stock, 50 cents or $1 is not going to be that big of a deal. But if we're talking intraday and we're talking the futures markets, well, 2-3 ticks now all of a sudden can start to put us closer to our stop. And for me, I like to use a 2-point stop on the ES. So if I'm a whole point off, I could get stopped out. And even if I'm right, so to speak, in the direction of the trade, well, if I get stopped out before it goes my way, then that really doesn't help me. So NYSE tick is much more useful for intraday trading. And then on those range days, it's even more beneficial because we can use those extremes and fade high ticks and then be buying in low ticks. On a trending day, what ends up happening is you can get a high tick and then you end up getting a higher tick and then yet again a higher tick. And so you kind of get into the same pattern of higher highs, just like you would if a chart was uptrending, higher highs and higher lows. And then opposite for a downtrend. So the extremes are the important thing. As we get closer to the zero line or stay closer to the zero line, you can kind of ignore those readings. Anything inside 400 is really just chop. So, and then that 1 period moving average can be helpful. I think the most important thing with your chart setup is to keep things as simple as possible. And if there's something on your chart that you find that's there, but you're not really using it to enter, manage, or exit the trade, then just get rid of it. For years, I had the time and sales scrolling on my chart, and it was just a bunch of noise, and it just was a distraction. And it took me a little while to realize that. So, just get rid of that stuff, and it'll help you be able to make sound decisions that you're not kind of second guessing yourself or hesitating on. You don't necessarily, so it can be when you're printing out charts, a 5 or a 15-minute chart, you can make some sense of it. You can maybe mark swing highs and swing lows and kind of use a highlighter and kind of practice, identifying the trend. But when it comes to looking for extreme tick readings, that's going to be hard to do with printing out the chart. So that's something that's worth either, being there when the market's trading every morning, or at the very least coming back at the end of the day and looking at, okay, I'm going to find all the plus 1,000 or even plus 800, minus 800. Those are fairly extreme tick readings in some cases, and finding those extremes and looking at where they correspond to the price data. So where that plus 1,000 tick reading corresponds with the E-mini S&P chart. So that's a really good segue into, the tick reading and what do they mean? as it corresponds to price. So if we have a high tick, like plus 1,000, and then we get a high price, say the high of the day, and those two things happen at the exact same time, then there's a strong chance that we could have the high of the day put in, especially if it's range bound. We'll talk a little bit about identifying some trend day scenarios here in a second. If we get a low tick of the day, kind of the opposite, and it lines up with low price at the exact same time, that could indicate that we have the low of the day put in, or at the very least, we have a temporary high or a temporary low that we can then sell, or sell near that high, or buy near that low, and then try to ride it, either if it's already a very clear range, riding that trade to the other end of the range, that makes for a good target. Or at the very least, getting 3, 4, 5 points out of it before the market ends up, rolling over and kicking you out. So when we get a high tick that doesn't have a high price, so let's say we print plus 1,000 in the NYSE tick, but then the chart isn't giving us a high price, well, then we could just continue to make new highs. And that's where the differentiator between a range bound day and a trending day can really become clear. On a range bound day, you have a high tick, market rolls over, maybe we trade down towards lows of the day, we get a low tick, lines up with low price, we start to rally and we make our way up to, back to highs of the day or some sort of range. But when we're in a trending day, you'll get a high tick print, say plus 900, plus 1,000, and then following that, maybe 30 seconds later or within a couple seconds even, you get a new high price. And so when you get a high tick that doesn't line up with high price, then you can just continue to make new highs, and that's a sign that you don't want to be fading highs. You don't want to be trying to buy lows, catching that falling knife. So everything that happens with the upside is the flip side for the other end, the downside. So a high ticket highs could be the high of the day, a low ticket lows could be the low of the day. When we get a high tick that doesn't line up with highs, we could continue trending up. When we get a low tick that doesn't line up with lows, we could continue trending down. Or sometimes what happens is we get a high tick, it lines up with high price for 10 seconds, and then the next candle or the next couple seconds later, we go into a higher price. And so that same thing, we have a high tick that doesn't line up with high price. So those are kind of the two scenarios, range bound day and trending day. The range bound day, I definitely will end up with more trades typically, because I might get in short and then we're down at lows, and then I get in long and then we're back up at highs and I can get back in for a short. Whereas on a trending day, as long as volatility isn't too high, to get into that trend and then stay in just by trailing my stop is the approach that I take, as opposed to kind of getting out and then having to get back into the trend and then take a small profit and get out and then get back in. To me, that's a little bit more risky, because if I can't get in to the trade again, I just end up missing a lot of the move. So I would rather just try to stay in the trade as long as possible on those trending situations. So the high tick at high price, this is kind of what my chart set up with the two side by side. You got the NYSE tick on the left, and then the ES chart on the right. It doesn't really matter if you're using, what time frame. I like to use a smaller time frame for the ES trading, but you could be on a 1 minute, you could even be on a 5 minute. But if you're looking at, you kind of have to be looking at it in real time, because if 8:30, or let's say 10 o'clock rolls around and you get a high tick and you see, okay, 10 o'clock and we're at a high price. If you got a 15-minute candle or 30-minute candle and you go back in time, it's going to be hard to see that if you're not sitting there kind of actively watching. So using Thinkorswim, there's a couple of little coding pieces you could put in to like indicate okay, here's a plus 1,000, or you could just put a horizontal line. That's what I like to do, kind of a dotted line up at highs at 1,000 and a dotted line down at lows, or some kind of gray line, just so I can see as a reference point, so I can quickly kind of trigger my eyes to be looking for those high ticks at highs and then those low ticks at lows. And so when you get a high tick at highs, there's a couple things you could do. If you get really proficient at the NYSE tick, you can look at just selling immediately when you get that high tick. You're going to run into some situations where maybe you get a plus 1,000 and then you get a plus 1050. So you could be a little bit early if you're just trying to sell market right at highs. But by and large, that's, you're going to be somewhere in the ballpark of highs. And if you give yourself a little wiggle room, maybe like 2-point stop, should be no problem to stay in. Or you could wait for some little pullback to either sell a retracement or wait for some kind of, at the very least, like a break below the low candle, the low price, of the highest candle. So you get a little bit of a retreat from that high price, just to signal, okay, yeah, we are starting to roll over. But at the very least, let's say you're up at highs of the day and it's some sort of double top from earlier in the day. Okay, now you've got multiple levels of resistance. You've got prior highs that are now retesting and are acting as a second touch of that resistance. And then you also have the high ticket highs, which is all of these stocks swinging one direction. Likely they're going to snap back, at least for the short term, and you can catch either a 4 or 5 point move, or ideally a move that's, if it's up at highs, down to lows, or if you're catching a move down at lows, it's a long that moves you up towards highs. On the flip side, if we're in a situation that is more of a trending day, you'll start to see, so like on the range bound day, see the zero line here? If we look at kind of the rough highs of the day, we'll just say, these are all about 600, and then down here, we're about minus 700 or so. They're pretty evenly distributed between those prints above the zero line and then the ones below the zero line. But if we go to a trending day situation, now we see more of a trending price action in the NYSE tick. And so we have more of lower highs and lower lows. And if we, in this case, a downtrend example, we are spending more time under the zero line than we are above the zero line. And so that's another kind of indication when we're looking at relative highs on a day like this, on a trending day. If you're making minus 1,000 prints, here's those little yellow dots I was talking about that just kind of signal, okay, this is a minus 1,000 or greater print. When you're getting those kind of extremes and the market moves up to, like in this case, a plus 200, that's actually relatively high. So if you're looking to put on a short in a downtrend and the market bounces, so we get that little bit of a bounce in the price action itself, just look for a high tick to kind of confirm your short. So rather than selling the low, trying to chase it or sell the breakdown, if you will, I would much rather be a little bit more patient, let the bounce occur, and then just look to get short on a relatively high tick. And so those trending days, you oftentimes the market can start to run away from you, and it can be a half hour in to the day and it seems like the market is really low if you're trending down in the day, and it's like, well, I kind of missed it. And if you try and just sell the low, there's a good chance that the market will bounce. And a lot of times, the initial thought that you have is with a lot of new traders coming into trading, the first thought that you have is usually the incorrect one, and it takes a while to sort of shift your brain to think in more like a chess game and thinking a couple steps ahead. So when the market is down at lows, instead of just selling that low, waiting for the bounce, looking for a corresponding high tick at highs, if you just get a bounce and the NYSE ticks are still hanging out at lows, well, there's a good chance we're going to be able to continue going up. And so you might be correct that the downtrend continued, but if you get short and then the market goes 5 points higher and it stops you out, and then it rolls over and goes lower, well, then you just lost money even though you kind of picked the correct direction. So the NYSE tick is going to help you. I don't think two points is very large at all on the ES, but it's also not super small. It's more than just trying to scalp. As far as a tick size go, I'm not looking to just take 2 or 3 ticks in profit. So using a 2-point stop, trying to get 3 points for a first target and then trail the rest of the position, just splitting the position in half, that still gives you a really good reward to risk, even if you only get that 3-point first target. And so by kind of fine-tuning your entries, you can maybe get a little bit better entry and then get that first target hit a little bit quicker and then have more profit in the trade. And so that would be the most ideal situation. You can also look at extreme ticks as a way to exit. So if you are short, let's say, and you got short when you were in a high tick, then you come down and make a minus 1,000 print, you could use that push down as a point to exit a trade. Now, I like to try and keep as much of the position on as I can. But if you're trading, 6-8 contracts, you have the opportunity. Let's say you take half off at a first target or a couple of contracts off at a first target to kind of reduce your risk, lock in some gain on the trade. You can take a couple contracts off at an extreme tick reading and then keep a couple more to continue trailing in case we do go lower. So those kind of, multi-level approaches with multiple contracts can really do a lot for the profit side. So now that there are micro contracts available, I would encourage, especially newer traders, spend a little bit of time on sim just to make sure you're familiar with your platform and your order execution so you're not making those kind of silly mistakes. And then spend some time on the micros, not necessarily trying to get rich, but just fine-tuning your entries and exits and be practicing with multiple contracts. So it will do you a lot more good to trade 2 or 3 micro contracts versus trying to trade one mini, because you only get one exit point and you'll be kicking yourself either way. You either exited too early or too late. And if you got stopped out on a trade that only went 3 points and you were trying to trail, then the next time you'll say, well, this time I trade, I'm gonna use a 3-point target and I'm gonna get out of the whole thing. When you only have one contract, so you only have one option. And then that trade, of course, ends up being a 20-point runner. And it's like, well, shoot, next time I'm going to trail. So with one contract, you're so limited to what you can do. Whereas if you at least get to 2, you can take one off at a smaller target and then have a second contract to trail. So it doesn't mess with your head quite so much. And that psychological component is super valuable. So practicing on the micros is helpful because you're basically risking nothing, and you can have multiple contracts. Yes, it costs a little bit more in commission, to trade 4 micros in some cases. You don't necessarily, my point is you don't want to be trading, 15 micro contracts when you could be trading 4 minis. But by and large, you can gain a lot of benefits by trading multiple contracts, but just do it in a way where you're reducing your risk. Even if you're coming to trading with $100,000 that's just disposable income that you're going to be trading with, don't rush out and trade 10 contracts. Make sure you kind of validate your trading approach with some hard numbers. So the other thing that I like to do, or one of the kind of big pieces that makes up my ES trading, is looking for those pullbacks on the chart that correspond with high and low NYSE ticks. So this is a screenshot from my chart yesterday. Market pulled back over here on the right. It pulled back to a halfway back point, and the NYSE ticks were already trending up and pulling back to this trend line. So as I drew up this retracement here, again saying, well, I don't want to just buy up here. I'd rather wait till it pulls back a little bit and then jump in the trade. I wait for that core. If I said, oh, I want to get long, the market's really moving, we gapped up and we started going higher, I want to jump in, I don't want to miss it. Well, if you just went to buy, 5 minutes or a couple minutes earlier, and you look over here at the NYSE ticks and you say, oh man, we're making high ticks right off the open here, it's early, and we're already making high ticks. Maybe wait just a little bit. You only had to wait a few minutes or if that, and the market pulled back, and then, okay, here we're in a relatively, we pulled back to the uptrend trend line, and we made that pullback. Okay, now that kind of validates, okay, here we are at the 50%. We're in a low tick relative to the other ticks in the trend, and that makes for a much better, cleaner entry point to at least, get the trade moving away from your entry a little bit sooner, especially with day trading, but in all trading, the time you almost need to be the most patient is at the start. If you get in the trade and then you move your stop to break even just because the market went up 2 ticks, well, you're going to get obviously stopped out right away. But if you can have a little bit of patience at the start and leave your stop alone, don't micromanage it right away, then as the market starts to lift and go in your favor, that's when it gets easy to manage the trade. When you're 6-7 points away from your entry, you've already got a first target and your stop is at plus 2 or 3 points. It's like, okay, at that point there's essentially no risk to you, and it's just a matter of managing the trade by trailing swing lows or drawing up the next retracement, or kind of keeping your eye on the NYSE ticks, and you say, okay, well, when it breaks trend, that's when I'll get out. But once you're in those winners like that, it's much easier to manage. So if you spend your time kind of focusing on mastering the kind of entry point or the criteria that you're looking to enter, then regardless of how the trade works out, it doesn't really matter. You shouldn't get upset if a perfect looking setup ends up stopping you out, because you want something that's repeatable. And if it's clear enough that you can identify it and 6 out of 10 work, that's certainly good enough if the average winner and the average loser and the winning percentage are, give you a positive expectancy. So the other thing I wanted to touch on is kind of a situation where this is for the NASDAQ, and rather than buying a low tick outright, it can be beneficial, especially in the NASDAQ because it moves so dang fast, to wait for, so these are 1 minute, this is my NASDAQ tick chart here in the bottom left, and it's on a 1 minute chart. I don't have that 1 period moving average on it. If you wait for that candle that got the low tick reading to break its high if it's in the low, or to break its low of the candle if it's a high tick reading, you can then jump over to your trade ladder and get in there. And so here we have the the low NASDAQ tick print, and then we get a kind of this rounded bottom, if you will, where the market comes down just as the NASDAQ ticks come down. But instead of just trying to buy the low itself, you could wait for, or what I like to do sometimes in the NASDAQ is wait for a break of the high price of that candle. So letting the market kind of round out a little bit, or sort of, if you think of like a train coming into the station, it's slowing down and then it stops at the station and then it turns around and goes the other way. rather than getting too excited and jumping in on the first sign of that extreme tick, letting it change direction and start moving up, and then jumping in sometimes it's just a few seconds later or a minute later, and then getting in with the upward momentum, and then just riding it out until you get either a move below the low price of a high bar, or when you come up to a relatively high tick reading, you could use that as your exit point. But because the NASDAQ moves so fast, you can get in and you can be up 10 points in sometimes a matter of seconds. So the entries are super, super critical with the NASDAQ, and you can get some really big moves in a hurry. But if you're just sitting there, okay, we're in a high tick, I got to sell. We're in a low tick, I got to buy. This kind of approach, more so for the NASDAQ than the ES, helps slow it down, and then you can kind of be a little bit more patient with your entries. Most platforms have tick data. I use Thinkorswim, that's the charts that you're looking at. TradingView, yeah, I don't know if there are some kind of alternative sources that you could pull in, or like use a different platform to look at tick data. You could always set up a Roth IRA or something, some kind of a retirement account with Thinkorswim, just to get access to the live data. Because if you just set up a SIM account, I think they're going to give you delayed data. So that's an option. I use Tradeovate for my futures order execution, and then I use Thinkorswim for my charts. I've used Thinkorswim for so many years. My eyes are so used to it. I like the charts a lot. The active trader is okay at Thinkorswim, but for years it was really slow and clunky. It's gotten a lot better, but I like to separate the two. That way, if my charts freeze, then I can jump into a trade still, or manage a trade from another platform. So that's I zoomed in a little bit here on that chart in the bottom left, and I have a line that kind of shows the top of the candle. So that's kind of the idea with getting in above the high to low bar that prints the low tick, and then the opposite for the high tick.
Tim, I gotta say thank you on a level. I've never been shown the tick chart or explained how it represents a trending day before, but I found that amazing, and I know that's going to help me in my trading.
Great. Well, I've just got one more note to share, and we can get
Sure.
things wrapped up. So I think the most important thing with trading is you can learn all this information. You can learn a lot of information, but you have to certainly be willing to take action. And even though you can learn a lot of stuff and talk to traders, or watch videos on YouTube and stuff like that, there's no shortcuts for the screen time. That just being in front of the chart when the markets are open and watching for yourself. I could sit next to you and say buy here, sell here, but if you don't understand why, then as soon as I leave, you're not going to have the confidence to pull the trigger for yourself. So that screen time is super beneficial, and there's really no substitute for it. So if you work smart and you're patient, and obviously the discipline that you hear with trading, it is critical. But even if you can just outlast, if you can be almost persistent and just day in and day out, keep working smart and keep being patient and keep being disciplined, then things will start to click. But if you give yourself a very short term, okay, I'm gonna quit work at the end of the week, and then next week I want to start trading full time, you're going to add a lot more pressures and unnecessary stresses that will cause challenges. So if you can work smart, you'll be a lot more kind of sustainable future for you in your trading. So that chart that I had, the NYSE tick chart, you can go to that link, eMoneyMind /NYSE-tick. If you use Thinkorswim, I've got the code there, and I've got just a couple of other screenshots kind of outlining how I use that. So if you're not on Thinkorswim, you can still get tick chart data. It's just you may have to, like Ninja has, there's some other indicators and things that you can pull in to get tick data and whatnot. But yeah, most platforms have it, NYSE tick or NASDAQ tick, and that link there has the kind of a little tutorial, and then the code as well, and some other day trading insights that you might find helpful.